The first step in analyzing the market structure is to find valid pullbacks. Pullbacks are considered a temporary pause before the price resumes its general direction. They are used to identify the basic price movements, trends, valid breaks, and reversals. So, how to identify a valid pullback? The pullback is a candlestick-based concept. The candlestick-based uptrend refers to a pattern where the market prints a series of bullish candlesticks that exceed the highest price reached by the previous one, indicating continued upward momentum. Additionally, the low point of each candlestick remains above or equal to the low of the previous candlestick, implying that the market's downward pressure is limited and the overall trend remains predominantly bullish. Same way, the downtrend refers to a pattern where the market makes a series of bearish candlesticks that exceed the lowest price reached by the previous one, indicating continued downward momentum. Also, the high point of each candlestick remains above or equal to the high of the preceding candlestick, implying that the market's upward pressure is limited and the overall trend remains bearish. In addition to analyzing the market trend, it is important to consider the candlestick-based trend as well. Now, how to identify a valid pullback? In the bullish scenario, a valid pullback is identified when a candle breaks below the lowest point of the previous one and sweeps liquidity. Here you can see that the fourth candle has broken below the lowest point of third candle, thus forming a valid pullback. If the price could not break it to the downside, the pullback was not valid for us. Remember, the candle color does not matter while identifying pullbacks. Same way, a valid pullback is identified when a candle breaks above the highest point of the previous one and sweeps liquidity, in the bearish scenario. Now let's see some more examples for better understanding. Here we have a bullish candlestick sequence followed by multiple bearish candles. This is our latest high, which creates the latest low. However, this is not a valid pullback because none of the candles have broken below the low, and this is a move inside the previous candle. We have no liquidity sweep, and therefore we will identify this as a single bullish movement. A similar thing happened in the second diagram. Market sentiment is bullish, and it has not taken any previous candle low, so we have no valid pullback here as well. On the contrary, look at the third diagram. Here the bearish and the bullish candles have equal highs. So taking the low of the bearish candle will make a valid pullback. Remember, the same concept will apply to the bearish market. You can apply this to any chart in any time frame. Now let's see some more examples on the real chart. Here we have pound yen in 1 hour's time frame. Let's identify the pullbacks and candlestick-based market movements. Starting from the left, this is our latest high and low. Since none of these candles have taken the low of this candle, it is not a valid pullback, and we will consider it as a single movement. To confirm a valid pullback, price must break below the candle that created the latest high. Following, we have a valid pullback because the low of this hammer candle that created our latest high is swiped by this bearish candle. Again, we have this deep pullback that broke below the candle that created our latest high. The next pullback has occurred here by this doji candle that has taken the low of the previous candles. In a bearish market, the price must take out the high of the previous candle that created the most recent low to confirm the pullback. This concept will take time to master, and you might witness various scenarios on the chart. Now that we discussed the pullbacks in terms of candlestick form, let me explain to you impulsive and corrective move. In the case of an uptrend, an impulsive move refers to a strong bullish movement indicating a heavy bullish momentum. On the contrary, a correction refers to a temporary market retracement or reversal that takes out a pullback. A break of structure occurs when the price breaks above a market structure level after a corrective move form, defining our recent high or low. It shows that the market intends to continue in the same bullish direction. A change of character occurs when the price breaks below the lowest point of a corrective move, indicating a loss in momentum. It is an early signal that we are no longer in an uptrend and might witness a reversal in trend. Starting from the bottom, here we have a single impulsive move that contains multiple pullbacks in terms of candlestick formation. The following move is corrective, since it has taken out the liquidity under the most recent pullback. After the market forms a corrective move, we define this level as a new higher high or a market structure level. And if the price breaks this structure to the upside, we will have a new higher low formation. Following, we have other impulsive and corrective moves that break the market structure. Now, the end of corrections or the start of the impulses are critical levels in terms of market structure. As long as we stay above these levels, we identify this market as bullish. If the price manages to break and close below these levels, we're no longer in an uptrend, and it signals a possible reversal. That's why we call it a change of character. The same concept is applied to the bearish scenario. Here we have impulsive and corrective moves in terms of candlestick. These moves are corrections in terms of market structure reading since they have taken out the liquidity above the minor structures defining the lower highs. So the change of character occurs if we get a break and close above this level. Here comes a couple of important points. Taking out the liquidity under or above the pullbacks could be by wick or a candle close. Both of them are valid. To confirm a valid break of structure or a change of character, we need to have a candle break and close over the market structure. Wicking below or above the zone is not valid. A corrective in the following impulsive move can contain multiple pullbacks, but the lowest point of correction is identified as the most recent swing low. Now let's discuss some more examples. Here we have the New Zealand dollar in the 1 minute time frame. Where is our valid impulse and correction? In this case, we can see here the market momentum is bullish. It made a pullback and push higher. The following move is identified as a correction since it has taken out the liquidity below this pullback. When the market breaks this higher high to the upside, it becomes our valid break of structure, which confirms this level as a valid higher low. Now we have to identify where is our most recent liquidity and pullback. As we discussed previously, this small area of consolidation is not a valid pullback because it has not taken the previous candle low. So the most recent pullback is here and liquidity lies beneath it. If the market makes a deep retracement and takes out the liquidity below this pullback and continues pushing up, we will have another valid break of structure. So let's see what the market will do. Here we can see that the market broke this level to the upside. But this is not a valid break of structure according to our rules. To confirm a valid break of structure, the market must take out the liquidity below the recent pullback. So this is our most recent pullback and it remains unmitigated. So the whole movement is an internal structure. Continuously, this area is our most recent pullback and the liquidity lies below it. So if the market makes a deep retracement and induces liquidity, it will be identified as a corrective move. We will have a valid break of structure if the market continues pushing higher. Here, let's analyze the market direction and movements. We are witnessing a bullish market, and this is our latest pullback, impulse and correction. The price has made a valid break of structure, confirming this level as our latest higher low. So as long as we stay above this level, we are in an uptrend. If the market makes a retracement and induces liquidity below the latest pullback, we will have another corrective move. Then if the market continues pushing forward, we will mark our new break of structure, impulse, and higher low. Now let's see what the market will do next. As you can see, the market broke and closed below our higher low, confirming this move as a valid change of character. Now after this case occurs on the chart, the market sentiment will change to bearish, and we'll expect a reversal in the trend. We will consider the movement that created the change of character as a new impulsive wave to the downside. So once again, we apply the concepts of market structure. First, we will identify the pullbacks and look for liquidity takeout to confirm our corrective move. This is our most recent pullback in terms of candlestick formations. So let's see what the market will do. Here we have a takeout above this pullback. So we have a correction that confirms this point as our new market structure. And then, the market made a break of structure to the downside, confirming this level as a valid lower high. Continuously, we will apply the same smart money concept to the market structure to identify the pullbacks, impulses, corrections, direction, breaks, and reversals. This concept is not limited to any pair or time frame, but mastering it will take time. If your trading setups are based on trend continuation, use them when you can clearly identify the market direction with the concepts we have shown you. Now let's discuss the next topic, which is analyzing market structure in multiple time frames. But before we continue, if you like us to make more videos more often, don't forget to support us with your likes and comments. By analyzing structure in structure, we gain a comprehensive view of the market conditions, allowing us to spot key levels, trends, and patterns that may not be apparent in a single time frame alone. This multi-time frame analysis empowers us to make better trading decisions, minimize risks, and increase our profit potential. So how exactly do we analyze structure in multiple time frames? Well, here are a few tips to get you started. We have two types of time frames in our trading plan. A higher time frame, which we will use to analyze the overall direction, higher time frame key levels, and generally the bigger picture. Then we have a lower time frame in which we will do most of our analysis, including analyzing market direction, supply and demand areas, liquidity zones, chart patterns, potential trading opportunities, and more. After applying the concepts of market structure, pay close attention to the alignment of structures across multiple time frames. Look for confluence and agreement between the two charts. When structures align, it strengthens the validity of your analysis and enhances the probability of a successful trade. Now let's see an example on the real chart. Here we have the euro-dollar chart in the 4-hour time frame. This is our higher time frame chart, and we will later zoom into the 1-hour time frame to observe more details and combine our factors. Here we have an obvious downtrend. So let's identify the most recent impulse, correction, and pullback. This is our latest pullback because it has taken out the liquidity above the previous candle that created the recent high. This move is our latest correction, since has taken out the liquidity above this pullback. So as long as we stay below this level, we will identify this as a bearish market. So, let's see what the market does. Now that we have a break and close above the latest lower high, market sentiment changes to bullish. Our higher time frame shows that, after a long period, the downtrend is over, and a possible reversal is coming. Now let's zoom into the 1-hour's chart to observe more details. In the 1-hour's chart, we can see that the market has made the change of character signal much earlier. This is our latest correction, which created a break of structure and define our latest lower high. Then we can see that the market failed to create a lower low, and finally price led to a change of character. So right now, both 1 and 4 hours chart signals a possible reversal. We can look for buying opportunities. Combining multiple time frames has many benefits, including gaining a broader perspective, confirming trends, identifying entry and exit points, and enhancing risk management. By considering different time intervals, you can make more informed and strategic trading decisions. So guys, I hope this video provided value for you. If it did, please hit the like button as it greatly supports us in creating more videos like this. Additionally, feel free to comment below and let us know what topics you would like us to cover in future videos. See you guys in the next episode.